everyone, my name is Ryan and I am a mortgage nerd. Welcome to our little show here, a little live feed for question and answers. I like doing this on my YouTube channel. I take on all kinds of different topics, that type of thing, and worked on a little lighting in my office. I need to work on maybe the cameras. The next thing I need to do is get a little better camera, but hopefully this is posting. I'm using a system called StreamYard. I've been kind of playing with it a little bit more. Got my microphone all ready to go, but it should be posting on my Facebook page. Should also be posting on my YouTube channel, which you can search Mortgage Nerd with the 3 as part of the E, kind of a fun little gamification, gamer tag kind of thing. And plus a lot of the mortgage nerds were already taken, so it just became kind of a fun way to say nerd. But I'd love to answer any questions that you have. I've got a couple here that are lined up, but if you want to jump in the chats, they should pull into this system is what I've been told, so hopefully that works. But I'd love an opportunity to answer any questions you might have about mortgage, credit, first-time home buyer programs, reverse mortgage, real estate, any of that type of stuff. We're going to stay on for maybe about an hour or so tonight. I try to do these maybe once a week or so, but love to answer your questions. So a little background on me. I've been doing home loans since 1999. I've been in Southern Utah since 2005, the whole time doing loans during that entire time, and just love Southern Utah, love helping people with real estate. And I can do anything that's involved with real estate. So I can do first mortgages, lines of credit, anything that involved real estate financing. The terms mortgage or home loan is probably the most common. But I'd love an opportunity to work with you. You can check out my website at ryanbolton.com. There's a free mobile app that's on there. There's a mortgage calculator that you can use without having to sign up for anything or have a username and password or anything like that. So we got some great tools on my website as well. There's a buyer's guide. You do just have to sign up with the email because it sends off a automatic PDF version of our little buyer's guide. And we produce that each quarter. So each quarter is updated with new information. And so you can check out the website for that as well. So let's jump into my little list of questions, but you can jump into the chats and let me know if you have any questions you'd like answered tonight. Let me find my list here. I had it popped up and moved it. And so let me find the list. Okay, so this was something I think is pretty interesting. So a lot of terms throw around in the mortgage industry. Abbreviations are thrown around a lot. And one of the ones I think that gets most misunderstood is second mortgages and what that even means. You've got terms like HELOC or home equity line of credit. You've got second mortgage terms out there. And really why we call it a second mortgage is it's usually a lien behind the purchase money or the first mortgage that you did. So on the title report, they're in second lien position. So if you were to be default or miss the payment on the first, the second's kind of in risk of not getting their money back because the first can foreclose on the property and the second just misses out on their money. Now, a lot of times they're loaning less than 100% financing, so they kind of offset some of that risk. But anything that's a lien against the property that's on top of the first mortgage is what would fall into those categories of a second mortgage. So this question here is, what is a very good second mortgage interest rate? So this changes a lot based on the type of second mortgage. You have home equity lines of credit, which are typically tied to the prime index, or when you hear the Fed's fund rate, or when the Feds change the rate, that's the index they're talking about. And that's what a lot of home equity lines of credit are tied to, that index. And what they'll typically have is the index itself, which at the time of this recording is 7.5%. They'll add a margin on top of that based on the risk, either loan to value, credit scores, loan amount, a couple other factors that will determine the risk on top of prime. So that's what is kind of a typical line of credit interest rate. Now you'll see introductory rates, and maybe it's lower than that for the first 6 months, something like that. They'll offer that every once in a while, but it depends on what type of line of credit. Now with the line of credit, they're typically interest-only payments, and you only pay interest on the amount you're borrowing. So let's say you get a $100,000 line of credit and you only borrow $20,000 of it to pay off a car or remodel or something like that. You only pay interest on that amount, but it is typically only interest-only payments. Now we have other loan programs as well where they're fixed rate lines of credit, but they're typically a little higher rate than the prime adjustable. And after a certain draw period, which can be anywhere between 5 to 10 years, the draw feature goes away and it gets amortized for the remaining term, typically the 20 years that are left. Doesn't lock in the interest rate, but gets rid of that line feature and then amortizes the balance for the remaining 20 years. So you just want to be aware of some of that terminology. If you have questions, if you want to get a specific quote, I can help you with how lines of credit or second mortgages work. But the benefit with a second is if you got some great rate on your first, but you have all this equity, you have other debts, or you don't want to relocate your home because you can't just replace the home, but you'd like to remodel it or do those types of things, a line of credit, second mortgage is a great option. Not perfect. There's maybe other ways depending on the finances, but so many more people have all this equity and don't want to refinance their 2 or 3 or 4% interest rate. So the line of credit for 20 grand or 30 grand or whatever it might be is a really good program. That's why they exist. That's exactly why that second mortgage option exists. So if you have questions about a second mortgage or you want to look at getting qualified for it, I can help you with the different programs that we offer. All right, let's check on a couple of the questions here real quick. Let's see. Oh, somebody tried to join, I think. Darren, I guess. I'm kind of new to this system, so I didn't know if that's something where... Yeah, okay. I'm still learning this new, it's called StreamYard. I thought people could just put something in the chat, but it looks like maybe there is a way to be able to invite people. And so, hey, we're learning as we go here. That's awesome. So you can put in the chat any questions that you have, and I can answer those specifically, and I'll kind of monitor when people jump in or not. So I don't know how to prevent that. Well, I guess we'll find out. Again, I'm new to the system, learning how all this stuff works. So I'm still trying to figure out exactly how to work with this system. So, okay. Let's go to some more mortgage questions. Let's maybe even try credit would be a good one. But if you have a question, go ahead and post it in the chat, and I'll get to those next. Let's see. Do banks check the property before approving a home loan? So the answer with that is typically the appraisal. So as part of the process of loaning, they want to make sure that what they're loaning versus what the home is worth is part of the collateral and will determine maybe the down payment you have to do or that type of thing. So do they check the property kind of before approving it? Yes, in a way, but it's through the appraisal. Now, if the appraisal comes back and says it needs repairs or needs something like that, that's when they'll kind of figure out, if they'll do the loan based on that. So if it's a really distressed property, that's when they're going to find out. The appraiser is going to say whether it's subject to completions or as is. So really the eyes of the lender a lot of times falls on the appraiser. That's who they're going to see photos. They're going to go around measure. They're going to do things like that to make sure that the asset or the collateral is going to match the criteria for the loan. So in a way, yes. Now, does the bank send a representative? No, it's usually the appraisal. Sometimes they will do a review afterwards to make sure that the person, say, moved into the property, owner occupied, that type of stuff. So that can be something kind of post-closing in some cases. Or if they have any kind of suspicion about the home, they can send somebody out. But it's pretty rare. Usually the appraisal is part of that. The home insurance, they sometimes will do an inspection as well. So there's plenty of eyeballs kind of looking at what's happening and just make sure that it's a legitimate property and that kind of thing. But I'd say most of the eyes, if you will, in this question are going to be the appraisal. Let's see. What is a good credit score to get approved for a home loan? So the better the score, the better the rates and terms. That's just how credit scores work, whether it's an auto loan or a home loan kind of thing. And it also depends on how much money you're putting down. So credit scores is part of the risk of getting a mortgage. So mortgage rates are a lot like insurance. The higher the risk, the more the rates and terms are going to be. And there's several things that factor into the risk. Credit scores is a big one. It's not the only one. So you could have all the other boxes checked, but have a 300 credit score, you're not going to get the loan. Or vice versa. You can have a 900 credit score, but maybe not have income or assets or the other things, and you still don't get approved. So there's really a combination of things, but credit is one of the better ways to get into the higher tiers, at least on the interest rates, the availability of certain loan programs. Most of the 100% loans that we see out there start around the 620 number, but if you can get to 660, rates and terms, mortgage insurance options open up a little bit more. Then the next tier is on 20-point tiers. So from 620 to 680, 680 to 700, that's kind of the buckets that you get put into when it comes to types of loans, down payments, credit, interest rate, mortgage insurance, all that fall into the category. So one of the most often questions I get is, can I get a mortgage with bad credit? The answer is yes, but the terms are going to be worse. So more importantly, what can we do to get your scores up? Let's do a review, give you a plan to be able to say, okay, go do X, Y, and Z. You'll get your score better, which will give you better rates, better payments on not only mortgages, but everything, car insurance, car loans, all that stuff. There's so many things tied to credit. So working on that is better than just trying to get into whatever loan's available kind of thing. And generally, the lower the score, you're going to run into more down payment requirements. So, and it's really not crazy hard to get somebody from, say, a 580 into the 600s if we know why they're at that score. But I can't tell you how many times people start working on their credit and they start to go backwards a little bit because they just do it wrong. What they'll do is they'll pay off maybe a old collection account that hasn't reported in a while and skipping the one that's reporting every single month. Or they'll pay off one credit card and close it, but without addressing the other credit card. So there is a right way to do it to just make sure you're getting your score up as quickly as possible. And that's where I can really help, is doing a free review, finding out why the score is the way it is, and then the tips in the right order to get the score up. I can't tell you how many times with 30, 60 days that we've been able to get scores up 20 and 40 points pretty easily. Even without necessarily a bunch of money, it's just a matter of going at it in the strategic way. Because credit bureaus report once a month, typically. And so you have to kind of go in these 30-day cycles to get things updated. So it does take a couple of cycles to do it. So the sooner you get started on credit restoration, the faster you'll be into a house. So I would say that's one of the best tips of getting pre-approved early is to work on credit stuff. Even if you're just barely below 680 or 700 or whatever it is, there's always little things you can do to get the score up just a little bit. So, but knowing why it is the way it is better than just trying to get any loan that works. So that's going to be a question that pops up a ton is, can I get a mortgage with bad credit? And the answer is yes, you just may not want it. Or it just really gives you such a high rate, such a high down payment that your buying power is so much lower, there's just nothing in the market you can even buy. Where just fixing the credit will give you more buying power, which means your payment the same for more money borrowed. So hope that makes sense. Let me check the chat here, make sure we're good there. Okay, let's see if we got anything else popping up. Okay, again, I'm using the StreamYard system, so I'm just trying to make sure I'm doing it right. But I used it last week on this live as well, and it should be posting to Facebook and YouTube, so hopefully it is doing that. So just post your questions are in the comments, and I can get to those as we get going here. Okay. Let me just make sure we got a good question here. Let's see. Is it possible to refinance a home with someone who is not on the loan but is listed on the title? Yes. So title is ownership and it's the collateral for the loan. But you can either add somebody to title as part of a refinance, or you can remove them. Say there's a divorce situation or something like that and you're refinancing to remove a borrower off the title report. So they don't have to be on the loan to refinance. But if they're on the title, they do have to sign if a new loan's being put on the property. So there's a lot of different ways that question can go and the reason for that question. But the shortest answer is yes, you can have somebody that's on the title then do a new loan, or not have them do the new loan, but just agree to the lien against the property. So again, the question is it possible to refinance a home with someone who is not on the loan but is listed on title? The answer is yes, you can do it that way. And usually that has to do with maybe income or assets or qualifying or something along those lines to make sure that all owners are on the new loan, which helps you to qualify. So that's usually what's in that situation. But what I'm seeing most often is unfortunately the other way around, where you've got somebody on title that you're trying to remove with a divorce or something like that, and you're trying to split equity, or one person's assigned the home. So you have to kind of go through just either selling the property or refinancing to cash out somebody's equity. That happens a lot more often on divorce situations. But the tricky part is if you both were on the loan and on the title, one of you will have to qualify without the other's income, and you can't keep the rate that you had on your loan. It is a new loan that replaces it, pulls out the equity. So in that case, a second mortgage doesn't really work because it doesn't remove the person off the note or the loan on the first mortgage. So a lot of stuff going on there. So if you're going through a divorce, need some help with liquidating real estate or doing a new loan, all that I can help you with that. Run through pre-approvals for either spouse, whoever's trying to keep the home, or if it just makes sense to sell the property, we also have ways to help you with that as well. So if you are going through a divorce situation, we can help with that for sure. Alrighty, let's see what else we got. Will I get a home loan for buying my father's house? Depends on if you qualify. So it's not going to be much different there. Now, here's a couple tips. If you're buying from a family member, you can have the family member gift you a down payment. So what I see most common in these situations, let's say just easy numbers, let's say the house is worth $300,000, but the dad only needs $200,000 because the other $100,000 is kind of inheritance or helping the kid. So they'll set the sales price at $200,000. What lenders will do is they go off of the appraised value or the sales price, whichever is less. So it doesn't matter if it's worth $1 million and you only need a $200,000 loan. If you put the contract at $200,000, then that's 100% financing to buy it at $200,000. So then the kid or family member, whoever it is, would have to put a down payment, even though there's all that equity. So what you're better to do is to build that down payment into the sales price. So in the same scenario, you take a $300,000 sales price, gift the $100,000, so then the new loan only has to be $200,000. Now it has to appraise for the $300,000, so you can't artificially make it higher than the appraised value. But this way you can get mortgage insurance gone, you can gift the down payment, you can gift the closing costs, and you can still net what you need to net on the house. So there's a way better way to structure families selling the property and do it legally and do it right and just make sure that it's done correctly by taking the equity of the home or the difference between what mom and dad need for the house, or maybe they've passed away and it's in a trust and the kids are trying to sell the house to one of the other kids. I mean, that's probably one of the more common situations, is where you have somebody passed away or go into assisted living and the kids want the house, or one kid of the 3 or the 4 want the house, but the other kids want to get cashed out. So there's really good ways to structure that that's completely legal and completely normal by just setting the sales price closer to what it's actually worth, and then gifting or crediting back closing costs or gifting the down payment. That way the other kid doesn't have to come up with money down when there's all that equity sitting there, or has to have mortgage insurance because with all that equity again. So there's just correct ways to get that structured. Now, one other cool thing you can do too, kind of on the flip side, let's say you have kids that want to buy a home, but they can't qualify. Maybe they're going to school. We have a lot of that here in Southern Utah, where you got a kid going to school and then like the next couple of kids are going to be right behind them going to school. So the parents want to buy like a rental property and just have them stay in that house for the next 4 to 8 years as they're going through school. If one of the kids can be on the property as a primary residence, the financing terms get dramatically better. I've helped many people with that. As long as one of the kids can be on the loan, they don't have to bring income or asset or anything like that, because the parents can completely qualify for the loan, but the occupancy of the kid can give you primary residence financing, less money down, better mortgage insurance. So these are kind of two reverse scenarios, but kind of using the system or using the way to maximize the loans that are out there by just knowing how the rules work. And it's not anything fishy. It's not anything scary. I remember one client was like, well, wait a minute, that seems like that's got to be fraud or something. Like the kid's not even bringing income or assets to the table. And said, no, as long as it has a minimum credit score, all the income and assets can still fall on the parents, just like it would on a rental property or anything else you're buying for the kids, but gives you a chance to earn appreciation, tax write-off, better rates and terms, less money down. So many ways to be able to maximize that option within the guidelines. So there's kind of two scenarios. If you're a family member trying to buy from a family member, I'd love to talk to you about how that works. We have the divorce situation, so we've talked about that a little bit. Or if you're trying to buy or co-sign with a child, you don't have to buy it as a rental property. You can, as long as the kid has credit. Doesn't need a job, income, assets. They can be a full-time student. None of that really matters as long as they can at least be on the loan as far as credit's concerned, and age. So they can't be 16. They have to be at least old enough to sign the contract. So have to be at least 18 for that concept. And a lot of times that works with the college kids. I've helped so many. I've had like 3 where it's like the oldest kid went to school, then the next kid moved into the same house while he graduated, and then they took over the house. So they had this house for like 8 years where the kids just kind of kept moving and graduating. And then by the time it was all said and done, they had like $250,000 in equity by the time, with appreciation and all that, and how long they were in the house, that they were all able to then sell that property and split that money up to go on and do other things with it. It was really pretty cool. It's just using the system that's out there. So there's loopholes, or I wouldn't say loopholes, they're just guidelines. Just take advantage of the guidelines that are out there. And there's just great ways to get things financed. So I think I'm getting buzzed a couple of questions here. Oh, I do have a couple of questions that are showing up on this. So hopefully, okay, let's see if we got, and you can enter the chat as well. Let's see what else we got. What are some examples of companies that buy out mortgages? So buyout's kind of an interesting word. You have the secondary market where they pool these loans together and sell them in big chunks to offset risk and those types of things. Mortgage-backed securities. And then buyout is sometimes where you'll have them buy the notes if they're in default or something like that. But in between that is just servicing being transferred usually. So it's not really anything where it's like buying out the mortgage as much as buying the servicing rights to collect the payment. And what you'll see sometimes in the mortgage industry is you'll have kind of an originator side, and then once it's kind of funded, then it moves to a servicing department that could still be within the same company, but technically they're transferring the servicing rights for that loan. So you'll see that happen a couple times, and there's other lenders that service other loans and they pool them together. I mean, there's all kinds of ways that the money moves around to keep the whole system moving. So you don't just run out of money for mortgage loans by being able to securitize these in big pools and be able to move the money around. That's a little inconvenient. People hate when their mortgage gets sold a couple times, usually right at the beginning. But some of that is just transferring servicing, not really selling the mortgage. It's just transferring to the actual servicing department. But they're not changing any terms. They're just buying the right to collect the payment or to handle the escrow account, handle the payments. So it really is a good thing that money is moving around. If it doesn't, that's when it gets more expensive and that's when rates are higher. So it's good that there is demand for these types of securities as they move around in the marketplace because they eventually become a security, just like bonds and just like other things. Let's see if there's any questions again. Okay, we'll keep going with some of the ones I have here. If you have any questions, please jump in the chat. Make a note if you can't. I don't know how you could tell me if it doesn't work, but I'm trying to make sure that this does work. This is called StreamYard is what I'm using. And it's really got some cool features. The intro, outro is kind of cool. The camera work. I can add guests. I can add screens. There's all kinds of fun stuff I can do here. So that's kind of why I liked it. So yeah, okay. All right, let's go to some other questions here. Oh, this is an easy one. What is the benefit of getting a mortgage pre-approval before house hunting? Boy, there's so many. One of the major things is not shopping for homes you can't qualify for. Because if you run around to a bunch of $600,000 houses and you can't afford it, then you're kind of setting yourself up for failure. But I also see it the other way around where people think, well, I can only afford X amount. So that means I can only do $300,000 and then we can work on a pre-approval to get their payment down or utilize their down payment in different ways to get their price point higher. So more often than not, the pre-approval allows you to make sure you have your price range correct and not overshop, but I have seen undershopping as well. So that pre-approval just lines that up and say, okay, here's the price range that you should stay in to make sure you get qualified for the loan. The other thing it allows you to do is get your ducks in a row. So when you do submit your offer, you can have a shorter time frame to close, which can make your offer stand out. Because if there is a multiple bid situation, everybody's asking for 30, 40, 50 days to close, and you can say 20, the seller is more likely to maybe take your offer, even if it might be a little less money, because it's more solid. It's able to close that much quicker. So there's a benefit for you to know what you qualify for, what interest rate, what programs are available, what down payment requirement, just kind of get your ducks in a row. And then when the home hits the market, you can make one of the stronger offers by having your pre-approval done. And every single seller, most agents, every builder, before they even start running you around to houses, they want to see that we've got a pre-approval. Otherwise, again, they don't want to sit there and spend their entire Saturday driving you all over town and find out, well, everything you looked at, you don't qualify for. So it's really the starting point. You really should start with the pre-approval before you even start the house hunting. And that's where I can help. And the best thing is it doesn't cost anything. There's no obligation. There's no cost. We just we get your information together, see if there's any red flags we need to deal with, whether it's credit or debt ratio or down payment source, whether it's gift funds. So many things go into a mortgage. By starting the pre-approval early, you'll have a chance to have less stress involved in the situation. I've had so many people that their lease is up in 30 days or 60 days, so they're a little more limited on what we can do, which is if they just want to start it a month sooner, 2 months sooner, just start getting some of their ducks in a row, it just makes it for a way easier process. So I highly recommend you do the pre-approval first. I'd love to earn your business. We do lending here in Utah and Nevada at Patriot. I'm with Patriot Home Mortgage right here on Bluff Street in St. George. We have other loan officers licensed in other parts of the country. We have branches in other parts of the country. So I can help you even just with answering questions, help with the pre-approval, and then direct you to somebody that can actually do the loan if you need to. That's the nice thing. I've been doing this so long. I know a lot of people, whether it's agents or title companies or insurance agents. So I can really help at least direct you to the right place if I can't help you directly. But why I'm doing the podcast, why I do all my stuff, is to hopefully earn your business as well, if it's Utah and Nevada especially. All right, let's work on a couple other questions here. Again, you can jump in the chat. Hopefully, if you post a comment on the Facebook, it'll pop up in this, so or on YouTube. But if not, then we'll just keep answering questions. Here's this question again. What is the process of removing an ex-wife from the mortgage without refinancing? You can't. If they're on the note, you got that loan with that person as part of the factor of why you got the loan. And so so many people are calling about that because they got great rates. You know, they got some sort of 4% or less interest rate, and they're going through the divorce, which sucks. And now they're trying to keep that mortgage. But to remove that person from the loan and usually cash out equity or something along with that exchange of asset requires the refinance. So you're at the mercy of today's interest rates. There's no way to save that mortgage interest rate. Usually what you'll see happen too is they end up just selling and starting over, but then you're still subject to the same interest rates. So it isn't something, and I would even say this, the rates on a purchase are a little cheaper than a cash out refi, depending on loan to value and credit score. So sometimes the rate is better on just a whole new purchase, but then you got kids involved, moving schools. I mean, it's ugly. Divorces are ugly. Bankruptcies are ugly. Those are just things that just kind of atom bomb credit and assets and selling and moving and all that stuff. But there really isn't any way to refinance somebody off a loan and keep your old terms. That's part of removing them from the note, that obligation, the title report, all that stuff does require a full refinance. All right, let's see how we're doing on time. Okay, any questions? You can add that to the feed. Why should or shouldn't one pay off their mortgage before retiring? This is a great question. And this is very case by case. There's going to be people it makes more sense than not. But I have found as you get closer to retirement, I see so many people that are like trying to get rid of that mortgage payment, putting everything they've got into it, instead of taking the same amount of money and put in savings, emergency funds, other retirement type stuff. So I think it's a diversification type thing. And I think having a bunch of equity you can't get to without selling or refinancing versus having the same amount of money earning a rate of return that's more liquid, I think can be better as you enter that age. You also see people end up doing a lot of reverse mortgages at that point. They got all this equity, but they can't qualify for a loan anymore because they've retired, their income's down, whatever it might be. Now they can't even get to their equity. Then they end up having to do a reverse mortgage, which is a great loan program. That's why it exists, but it's more expensive than a traditional mortgage. And if you just had the cash to begin with and were disciplined with that, you can get kind of best of both worlds. So especially if you got a really low rate on the mortgage, like if you have a 3-4% interest rate or 5 even, you're better off keeping that debt than any other type of debt and just build your savings that can then offset the payment or the interest rate or those types of things. So I'm a big believer that there's other places to put your money. When we talk about diversification all the time, you wouldn't put all that money in one bond or stock or gold or something like that. You'd diversify it. Yet you'll put all of it into paying off a mortgage, which then again, you can't get to the money without selling or refinancing the home. And what if you can't qualify for a refi? What if rates are worse? You know, all those things, I think you're better off to keep the cash and get it to where the payment is still comfortable to make sure you can still qualify or make sure that payment, that debt servicing is okay. And it's case by case. There's some people it just makes more sense just to get rid of the mortgage if they have plenty of other assets. But most cases, would you rather have $100,000 of equity that you can't get to without selling or refinancing, or $100,000 in the bank? Most people would rather have the money in the bank that I've talked with, because even that $100,000, if you have a $2,000 monthly payment, it could offset the payment for how many years, or even eliminate the whole payment for the next few years. It's the same as giving it all the money to them today versus spreading it out over the next 10 years. So you could subsidize your payment with those savings if you have the access. So I really believe that having the money in the bank gives you way more control than all that equity. So I'm a believer not to, but that's my reasoning for it. If you have a different reason, if you think that's wrong, love to hear your comment on that. How can I get a small business loan to buy a house? You can. The SBA does allow for home ownership. I think the interest rates terms are going to be different than most mortgage loans because that's really what it's for. But it is depending on the usage of the house as well. So you can, but typically regular mortgage loan financing will be better than some of the SBA loans that are out there. But you can. I think SBA requires 10% down. I don't do SBA loans. I do real estate loans, but I think it's 10%, where a lot of the residential loans can go up to 100%. And I think rates and terms 30-year fixed instead of some sort of 10-year recast or those types of things on those loans. But again, I'm not an SBA lender, so I don't know exactly how all the SBA loan type work. But generally, the rates and terms are going to be better on just a residential loan, from what I understand. What are the consequences of not paying property taxes on time after closing escrow with an FHA loan? So closing escrow is kind of an interesting term because that means you just close the loan or settlement, that type of thing. If you closed your escrow account, I don't know if you can close your escrow account with FHA, but the consequences of not paying your property taxes. So if you don't pay the property taxes, they're actually a lien ahead of any other liens. IRS tax liens, there's a couple things that can jump ahead of that. You got HOAs, they can actually jump ahead of any other liens. They have a priority where they can jump ahead of the existing FHA loan or conventional loan or whatever it might be. When it comes to lien position, that is when you start to foreclose on the property outside of those types of government type defaults. The first mortgage gets paid first, and any other loans are behind that in the stage of foreclosure. So if you don't pay the property taxes, that's where eventually, even if you're paying the mortgage on time, the collateral that's tied to the loan or tied to the taxes could be taken away. Now, it depends on the state, depends on the country or state or county, or depends on where it's at, how quickly when you default on property taxes, when they actually start to try to do the foreclosure process. I've seen somewhere it goes like years before they do it, but then the amount and the penalties and the interest and all that kind of stuff can go up pretty high. But there is auctions where you'll have these properties that come available from the counties that are actually selling it to pay off their property tax debt, and they're taking back the home, and the mortgage is just out their money. So what I've seen sometimes is the mortgage company will be the opening bid to at least get the taxes covered, and then that's when they'll start a foreclosure or something like that, depending on what's happening. Because generally, if you're not paying the property taxes, you're also not paying mortgages and things like that. But the short answer is, if you don't pay the property taxes, they can still take away the home. All right, let's see what we're doing on time. I want to make sure I hopefully know he's posting questions that aren't showing up on my feed. If they are, I'm sorry, but I'm still learning the system. So I hope you find this useful, whether you watch it live or whether you come back and watch it another time. Love to earn your business. We do lending in Utah and Nevada. I've been doing home loans since 1999, and love to earn your business. All right, let's see what else we got. It's all live, baby. Who knows what questions we'll come up with. Can we take a home loan, put it up for rent, and pay the mortgage with the rent? Kind of. So you can rent a room. You could rent the basement. But if it's not your primary residence and you got a primary residence loan and you immediately turn it into a rental, that can be considered mortgage fraud. Occupancy is one of the number one frauds in our industry because the rates and terms are better if it's a primary residence than a rental property. So why is that? Well, if it's a primary residence, you're less likely to miss the payments. You're more likely to maintain the home, maintain the taxes, maintain the insurance because it's your actual home. And you would have to get kicked out, your family, your kids, all that. You would have to get kicked out. You have to go back and find a rental property. So the debt that gets defaulted the least is primary residence, residential financing. So as soon as it turns into a rental, there's higher risk. Because of that higher risk, that's why they want more money down, different rates and terms, different programs for that type of lending. So occupancy is a big issue there. So if you go into it and you're renting out a room, that's fine. If you're renting out a basement, that's fine. But if you just never really even move in, just turn it into a rental right off the bat and then use that to make the mortgage payment, that can be classified as mortgage fraud. Now, there's legitimate reasons that does happen. I had a client that was going to move in, and I don't remember if he lost a job or the job was transferred. It was like something like that. Either lost the job like 2 weeks later, or I think he was transferring. I think they gave him a huge opportunity to transfer. So instead of selling it, he did turn it into a rental, but we could document and show that wasn't the intention at the time of signing the loan. Stuff does happen, but that's pretty rare when it happens that quickly. Usually it'll be a few months down the road. That doesn't mean it has to be a primary residence forever, so it can turn into a rental completely eventually. It just can't happen kind of as quick as this question is asking. There definitely needs to be a time frame that makes sense of why now it's a rental property. And but you can rent room or basement or space or that type of thing as long as it is still your primary residence. If you got a primary residence loan, which I'm guessing that's what happened here. Can you buy a house with your spouse if only one has good credit? No. So the way the credit works, regardless of how many borrowers, you could have 1, 2, 10. I mean, I've never had 10. I wonder if anybody's ever had, like, what's the most? I wonder. There's got to be somebody out there that's had like 15 co-signers or something like that. The most I had was 6. There were 6 borrowers, brothers and sisters, husbands. Yeah, I mean, it was a big bunch of people that kind of came in to buy this home together. But whoever's the lowest credit score, that's what the credit score tier is based on. So you could have, let's say there's 3 people, and you got an 800 score, and a 550. The 550 is the one that will actually determine the rates and terms, regardless of the other 2 credit scores. So, but if you need their income to qualify to make this work and you need all 3 incomes, then that's where it's worth working on the credit score. So you can't use like the best credit score, but the other person's income. So it is whatever's the lowest of the borrower's middle credit score. And what that means is we pull 3 credit bureaus. You have TransUnion, Equifax, and Experian. We take whatever credit score is in the middle of those 3, then the lower of everybody that's on the file. Most common is going to be husband and wife. There's going to be 2 borrowers. So you could have the wife have a really high credit score and the husband not have as good a credit score, but he has all the income. So it's not an income thing. It really is a factor in the credit score. So the short answer is no. You can't have, it's whoever's the lowest middle score determines the tier for pricing, loan payments, interest rate, all that, regardless if everybody else's scores are way higher. All right, how are we doing on time? I want to do this maybe maybe an hour or so, so we're about 40 minutes in. We'll keep rocking and rolling. How can a mortgage calculator with taxes help homeowners? So there's a lot of mortgage calculators that are out there that'll just give you the payment on the loan itself. But there's other things that factor into a mortgage payment. You have the principal and interest on the loan, which a lot of calculators will do. It's just like a car loan, like anything else. You have what you're borrowing, amortized for 30 years, what the interest rate is, and bam, that's the payment. But what gets added on top of that is the yearly insurance and the yearly property taxes. So here in Utah, taxes are due every November. So instead of coming up with that lump sum every November, most people in Utah divide that number by 12 and it gets added to their mortgage payment. It's called an escrow account. So that way, when you're making your mortgage payment, there's a little bit of money that's siphoned off from that pays the property taxes. Same thing with the homeowner's insurance. Once again, it's a yearly fee, and it's usually based on the month that you close a loan. So here we are in May. You pay for the homeowner's insurance this month. Then it would wait 12 payments, and then you owe a renewal in May. So the taxes could renew in November. The insurance would renew in May. So they can kind of be different when the money's coming in and out of the account. But it's a lot easier just having that divided by 12. So there's no interest that gets charged on it. There's no fee or anything. They just take whatever the yearly amount is, divided by 12, and add that to the payment. So when you make the mortgage payment, you're covering those 2 expenses. There's 2 other things that can factor into the rest of your mortgage payment. You might have mortgage insurance. So if you don't put 20% down, you'll have to add this extra insurance that's not homeowner's insurance to cover the lender by not putting enough money down. And that can be all over the place. You've got certain ones that have to be on the loan for the entire life of the loan. They're a percentage. You have other times where you can pay a one-time fee and remove the monthly mortgage insurance. You have other ones that are like prepay some amount and have the monthly amount be less. Some can be canceled after 5 years, some after 10 years. So there's a lot of different mortgage insurance options out there. But really, it's an incredible way to get closer or higher loan to values, closer to 100% financing because of mortgage insurance. Otherwise, everybody would have to put 20% down. And so mortgage insurance is a great risk adjustment to allow for higher loan to values and help people get into more homes. And then lastly, you might have an HOA. So HOAs are homeowners association. This is a separate fee, but still something you should factor in as you're calculating your mortgage that is separate. And it usually covers maybe if there's a tennis court or a basketball court, maybe the landscaping is covered. Maybe you'll see subdivisions that just have kind of one water to the entire project and they just split that bill up amongst all the homeowners. So an HOA is where you'll also have a fee you want to be aware of. And that's why it's hard to nail down exactly what somebody's pre-approved for, because you got to also kind of find the home to add the tax insurance if there's mortgage insurance, or just kind of make sure that's within the range. So when people are out there looking for houses, you kind of have that built in as well. But if let's say you're approved for 500,000, but then there's a $200 a month HOA, you won't be approved for 500,000 anymore. You've got to lower it to offset that expense. So it is important to be aware of the homes you're looking at, if what the tax insurance, what the mortgage insurance, and what the homeowner's insurance is on top of the mortgage payment. So my website's got a great mortgage calculator, factors all that in. It has some defaults that are in there based on the price to make sure it's kind of giving you a more accurate number. The last thing you want to do is use a mortgage calculator that says your payment's $2,000, and then it ends up being $2,700 because all the other stuff, because the tax insurance, mortgage insurance, HOA adds another $700 or something like that. So you do want to make sure that the calculators you use do factor in those other parts of the payment. So I hope that helps. Let's see, how are we doing time? We're doing great. Hope everybody's having a great Friday. Today is Friday, May 9th. I don't know when you're watching this video. This is live right now, but if you watch it later on, we're kind of in the month of May here. Here we go. Why might a fixed rate mortgage be ideal for homeowners planning to hold their property long term? Well, that's what a 30-year fix is supposed to do. So if you're short term, you might be better off with the short-term mortgage, where if it's a longer term loan, the longer you keep the loan, the more that the cost to get the loan is justified. So that's where buy downs have slowed down just a little bit, because a lot of people think, well, if rates get better, I want to be able to refi. So we're not seeing buy downs or paying a bunch for an interest rate today, because there is a thought that interest rates may get better. So let's have a conversation about that. Everybody's sitting there saying, well, I'm going to wait for home prices or interest rates to come down. And yeah, everybody wants to time the market. Nobody wants to overpay for a house or overpay for an interest rate. But I'll tell you this, if there's 100 people that all of a sudden hit the market for the same home, that home's price is going to go up more than the benefit of the lower interest rate. So it's really more about finding the home. We have a saying in the industry, you marry the home, you date the rate, meaning that you can always refinance if interest rates get better, which is an if. They could get worse. I think there's more pressure for interest rates to go down, but there's still a chance they'll stay the same. They have for quite a while so far. And if you look at the 70-year average, we're actually below the 70-year average. Now, we're not the 4s and the 3s that we saw a few years back, and we may never see those again. But if you're waiting for the interest rates to go down, everybody else is as well. What's going to happen? More buyers for even the limited inventory we still have. So it'll be a pricing war again. And if you have 100 buyers, the one that can qualify for more payment or offer more is going to end up with that house. And if all of a sudden it's $50,000 more than what you could have bought today, even though the rate dropped a point, you'll still be more monthly payment. Plus, if you're another year renting a home, how much money did you lose just on paying $2,500 on rent, waiting for some magical interest rate? So I think it's more important about, what do you qualify for today? Get into home ownership faster is always better. It's a long game, not a short game. Get into the home that works. Find one that fits, what's in the budget, that fits down payment requirements, that fits the monthly budget today, because it could get better over time. I mean, how many people right now have a payment that's just way lower than what they can replace it with? That's going to happen again in 5 or 10 years. And often I look at people and say, well, what's your interest rate on your rental property? And they kind of laugh, well, it's 100%. It's like, no, it's like 108%, because you're losing appreciation, losing tax benefits, losing the locked-in feature of a mortgage. So mortgage payments will adjust with taxes and insurance or HOAs. They'll adjust a little bit, but not nearly as much as rentals can adjust. So I'm a big believer in real estate. I'm a big believer in the long-term nature of it, that you're going to have a housing expense. You might as well own it. And there's so many programs out there to get you in with little to no money down, or to maximize your down payment if you do have one. It's just way better than renting. And I know it's tough. I know the market's really tough. And I get so many people that need to afford homes that just don't seem to exist right now. They're definitely not building them in the price range we need to. That's a whole nother can of worms that we can open up. But it's still, get pre-approved, find out where you're at, and when the home hits the market, you can jump on it now, instead of waiting until another 100 people can also buy that same house, especially in the lower price range. Like, everybody's waiting for the rates or the crash are under the median home price. So it's just a huge wave of buyers that are in the lower price range, which isn't going to make that price range go down when there's more buyers. Now, the upper end, sure, there might be more soft in the upper end, because it takes more income to qualify, more down payment. They're relocating from another area. They're not bringing their job with them, because the job market here is going to be less than just bringing their retirement with them, or remote working, or whatever it might be. So there's going to be struggles in Southern Utah. We're definitely a resort community, and the price versus income has always been an issue here. Affordability has always been an issue. But being ready when the home hits the market is better than timing the interest rates. It just is. And if you can qualify, you're better off to do it now. You can always refinance if rates get better. If they get worse and the home prices get worse, then you're like, man, I'm really glad I bought it last year or 2 years ago or whatever it was. I don't know anybody that regretted buying a house 5 years ago or 3 years ago. Even after the '08 crisis, people took the hit. And 3 or 4 years later, especially in southern Utah, it was almost back to where it was before the only crash we've had in 100 years. So yes, there's things to consider. Real estate is local. Job is important. Credit, what you can qualify for. I mean, all those things come into play. But don't wait until you hit some magic interest rate to get started. The sooner you start, the sooner you'll be ready when the home hits the market. Or if rates drop, you're ahead of that curve just a little bit. That's where people make money in the real estate, is they're always just ahead of any ups or downs that happen. So hope that helps. I'd love to earn your business, whether it's me or somebody else. Get pre-approved, get the loan, get ready to go, get your ducks in a row. And when the house hits the market, you can be the first one to make an offer. And you can say, I can close faster, which can make your offer stand out if all of a sudden there's 4 or 5 other people that also can target that price range. So anyway, that's my soapbox for this show tonight. All right, let's jump on to... Maybe we'll change categories. Well, there's been some good questions here. We'll just kind of keep going. What documents can I use to prove child support when trying to buy a home? Child support's a little tricky. Most lending guidelines require that there's a continuance or a likelihood of continuance for at least 3 years. So the children have to be under the age of 15 on the birth certificate. Even if they're going to school or it says they have to continue the child support after they're 18 until they're done with school or college. Most lenders are going to go right up to kind of that 18, kind of worst case on the 18. So they have to be at least under the age of 15 to show it'll continue for 3 years. Next, we have to show they've been making the payment for the last 12 months. And let's be honest, a lot of them don't. They either have to get garnishments or they don't pay the amount or the amount's spread out or it's paid differently or paid in cash. I mean, there's lots of different ways. So you have to document they made the payment that they're obligated to for the last 12 months. So that's really the 2 criteria to use it. And I would also say most of the time, if we can qualify without it, it's better off, because that is, if you need that to qualify and it does go away or doesn't make the payment, you're kind of putting yourself in a bad situation for the kids or for other living expenses by not having the child support. So can we use it? Yes, there's guidelines for everything. There's a way to be able to fit people into boxes all over the place. So that's really the short answer, or the guidelines for child support, is the 3 years of continuance and showing 12 months of payments on time. Oh, here's a longer question. All right, let's just see what it says. I am 30 years old with no debt and $100,000 saved for a house. It will take 2 years to save another $100,000, at which time I can pay cash for a house. Should I buy now with the mortgage or buy later? Buy now. Buy now, especially with that much money down. But also, where's a $200,000 house? So I don't know if this is what state or where this is at. But that's the thing. If you wait another year, the price will be more. And get into the house now. Take advantage of the tax benefits. The $100,000 you're putting down could make the payment on the $100,000 for the next 10 years. So, and what are you going to do until then? Pay rent while you can buy? I mean, this scenario, there's just no reason not to buy, especially in that scenario. If you're going to have a housing expense anyway, rent or something like that, you might as well own it, especially in this scenario with no other debt. I mean, what are you waiting for? What? You're waiting just to be able to pay cash in 2 or 3 years? Well, in 2 to 3 years, it's probably not available, or it's going to be more expensive anyway, where you can take advantage of the appreciation during that time, any tax benefits. I would say it's way better to buy than wait in that scenario, especially. In most scenarios, it's better, but especially that one. What risks do home buyers face by skipping first-time home buyer programs? It's not like it changes the risk. So it's really more of a guideline difference, and some programs open up and that type of thing to use the first-time home buyer, but you don't have to. You could be a first-time home buyer and not use first-time home buyer programs, and it doesn't really change your risk. So really, I don't see what the risk would be to not take advantage of first-time home buyer programs, and you don't have to. Now, also a first-time home buyer is anyone that hasn't owned a home in the last 3 years. I know that sounds weird. When you hear first time, you think ever. Like the first time I rode a bike or the first time I kissed my wife, you don't have a second time. But with designation, it's 3 years. So you could have owned 100 homes, but you haven't owned a home in the last 3 years. You're a first-time home buyer again. So you can have access to these programs by having that designation, but it doesn't force you to. It's like if you have the money down and you don't need the mortgage insurance and you don't need some of the guidelines, you don't need down payment assistance, you don't need the more common things people need as first-time home buyers, you don't have to use them. That's part of my job. Sit down with a client with their scenario and say, okay, what's the best loan? What frees up the most money? What hits the goals we want as far as price or payment, whatever it might be. That's part of my job, is to show, okay, here's option A, B, and C. Here's the benefit of A, B, and C. Here's what we need documentation-wise for A, B, and C. And a lot of times we can narrow down which one makes the most sense. And that's the fun part of the job, is problem solving. When a client comes in with a need, a want, or whatever it is, we have solutions to help lend money. And I've often made the joke, I sell money for a living. That's part of my job, is to sell money and fit the borrower to the best loans and the best money that's out there. So I've had that question pop up a little bit more often. Do you have to use first-time homebuyer programs if you are a first-time home buyer? You're really just more designated to that, as far as that's what we would call somebody who hasn't owned a home in the last 3 years, but it doesn't mean you have to use the program. And it doesn't mean there's not more benefit to or not to. It just depends on the client, depends on the loan. That's why these exist. It's a capital thing. It's a free market type thing. What are the needs in the marketplace? What risk are we willing to take on? What guidelines do we want to avoid those risks with insurances or government-backed or whatever it is? All of it's designed to fit a need within the marketplace. And there's a lot of lenders that are willing to lend, because real estate's a great investment. It's a great capital. It's great collateral is real estate. It's not going anywhere. Car, who knows where it's going? A signature loan, who knows where it's going? But a house, there it is. And so it is something where it's one of the better loans. That's why you get better rates and terms, and why there's so many programs to help people into home loans. All right, how we doing on time? You can post a comment, and hopefully it will show up in the feed here. Let's see. I want to make sure I'm not doing something wrong, but it looks like I've got it all clicked on here right. This is called StreamYard. It's been great. I've been having a lot of fun with it. A little shiny. Oh, man. All this lighting. It's like interrogation. All right, what else we got? We're in the hot seat. We're in the hot seat, people. Can I get a home loan to buy a property that is not registered under my name? No. So as part of buying the property, you get added to the title. So that's part of the title company. That's part of what we do, is we securitize the property that you're now owning. So there's a little process there of title work and making sure ownership changes, and we get insurances and stuff like that to make sure you are the owner and it is the collateral. So, but as far as just, that'd be like, okay, I want to go get a loan on that guy's house. I don't own it, but I'm going to get a loan against it. What happens if you don't make the payment? Then somebody just knocks on the guy's door and say, hey, Chad down the street got a loan against your property and he didn't make the payment, so we're foreclosing on your property. I want a loan on the Delta Center. Is it still called the Delta Center? Uh-oh. I think it is. Is it now? Yeah, it's the Delta Center where the Jazz play. Or the SoFi Arena. I want to get a loan. I don't own it, but I'm going to get a loan against it. I'm sorry, I don't mean to laugh, but yes, you cannot get a loan on a home you don't own, and if you're buying it, that loan is buying the property that you're eventually going to own as part of the process of the loan, just like a car loan. So you're not on the title of the car loan yet until you get the loan. It's all kind of part of the same time you're signing paperwork that adds you to the title. All that kind of happens as part of the loan. So same thing with the mortgage. The loan that we're doing is going to make you the owner of the property. And I hear people all the time say, well, I just rent it from the mortgage company. And that's silly. Yes, if you don't make your payment, they're going to take the collateral away, but they do not own the home. They're a lien against the property. It is collateral, but you don't rent it from the bank. It's not like the bank's going to show up and say, hey, I've got a bunch of executives in town and we really like the pool that we saw in your appraisal, so we're going to use your house. You got to move out for the next couple days. Of course not. The lender's not going to tell you if you can paint the house or have pets or any of that type of stuff. It's just the collateral that if you don't make your payment, they can take that asset back to get their money back. But then you don't rent them. You don't rent the house from the mortgage company. It's a totally different thing. So anyway, that's a little another soapbox. 2 of them. Anyway, all right. How we doing time? Got to look past my camera here. I want to do about an hour. We're about 5 minutes too. So if you have any questions, you can post it to the live chat. Can you purchase a home with no money down and use the equity to buy another home? Possibly. So it depends on what you're buying the house for if it has any equity. So I've seen this situation again where a family member sells it or something, they get a really good deal in the house and there's a bunch of equity there. So there is lenders that will do lines of credit based on the appraised value, but most are going to have what's called title seasoning. They want to see that you've owned the home for a certain amount of time before you can go off the appraised value and not the original acquisition cost. Second mortgage are a little different. They're a little more unique on what they'll factor and what they'll consider when it comes to value versus acquisition cost. But almost all of them are going to have some sort of 6-month, 12-month kind of waiting period before they let you use the appraised value versus what you originally acquired it for. Not always. There's definitely lenders that are out there that want to loan money. And if you somehow got just a screaming deal on the house from a family member or an inheritance or something like that, then yes, you'd be able to tap into the equity if it is there. But most of the time you're putting money down or you're buying the house at 100% financing. There's not a lot of equity at the beginning. That's why there's mortgage insurance and other things to offset that high loan to value. But there's scenarios where absolutely, like if you got a house that was inherited for $200,000, it's worth $400,000, you got $200,000 worth of equity there. Now, one thing to consider with equity as well, whether it's a divorce situation or a second mortgage, almost all of them don't go to 100% financing because they know you're going to have agent costs, price reductions, maybe rehab costs, things like that. So most are going to go to about 90% of what the home's actually worth on second mortgages. Now, we see times where they do go higher than that, but that's been the standard for quite a while because they want that 10% cushion for foreclosure, to have to sell it. That's just the higher risk to lenders is to be that high loan to value. And so when you're going through divorce as well, you have to look at it and say, well, if we had to sell this home, we'd have expenses to sell it. So it's really not a 50-50 split of just value minus mortgage and we split that 50-50. There really should be a factor of saying, okay, well, if we went to sell it, we'd have real estate commissions, title insurance, maybe a home warranty. We'd have some of this stuff right off the top. Or maybe husband or wife put the down payments. Like, well, we got to kind of factor that into the equity because I put the $50,000 down to buy the house. So that's part of negotiating kind of what is the equity split. But I see so many times where people say, well, you know, it's worth $4 and I owe $2, so I have $200,000 in equity. Yeah, but that equity goes to fees. It goes to maybe price reductions if you have to sell it. Maybe you got to do a home warranty. Maybe you got to clean and fix it. And so you want to kind of take a good number is 10%. If you take 10% right off the top and work the numbers from there, you'll be pleasantly surprised in most cases. Then all of a sudden, oh, well, I thought I was going to make $200,000. I made 190 or 180 or 160 or something like that after everything's said and done. So just keep that in mind when you think of the equity. You want to take 10% is a good number, just kind of right off the top to make sure you're kind of working your numbers backwards from there. All right, time. Ooh, let's see if we can get a couple more in here tonight. I'm trying to do these maybe once a week. I don't know if Thursday or Friday is a better night. Maybe Friday everybody else is doing something. I mean, you guys aren't thinking about mortgages on a Friday night? What in the world? What else is there? Just kidding. All right, just kidding. All right, let's see what else we got here. All right, we got a few more minutes left on tonight. Let's see. Here's a question I get a lot of this form of this question. How much of a house can I afford with a $100,000 salary? So it also depends on your other bills. So we have two debt ratios we look at when we do a home loan. You have what's known as the front end, which is just the mortgage itself. The back end is all the other expenses. So car loans, student loans, visas, all those types of things. So it can dramatically change based on the other debts of the property. So it's not like every $100,000 salary can afford a $400,000 house. It depends on the other debts that are factored in there. And that's part of my job is to sit down with the client and say, okay, here's kind of your debt ratio. Here's your qualification, what mortgage payment you can qualify for on that. Depending on your credit score, that debt ratio can go higher. Depending on down payment, that can go higher. So there's a lot of factors that go into it. It's not like a silver bullet that if you make X amount per month, you can afford this type of house. There's other factors that can make a big difference. If you have $100,000 worth of income and got $100,000 worth of debt, you can't get a mortgage loan. There's too much debt. Or vice versa. You could have $100,000 in total income. You can afford a much more home. And that also ties into down payment. A lot of times, instead of putting the money down, you can use it to pay off other debts, which helps your qualification. All of this is part of the pre-approval. All these questions can be answered by starting with pre-approval. So that way you're able to check these boxes off and know exactly what you qualify for. Or fix something so you qualify for more. Again, like redirecting down payment maybe towards paying down a car. We did that with a client, had like a $700 payment. So we put money down on the car, which saved him more than putting down payment on the house, which then allowed them to qualify for more for the same monthly income. So there's really creative ways to get this to work. And most people kind of come with ideas that don't really fit what's out there. That's part of my job, is to help you figure out what you can do with your scenario, maximize the income, maximize your down payment, so you qualify for as much home as possible or the cheapest payment on the same house. So that's part of my job as well. So fantastic. See if anybody's in the chat or on the feed. You can post a question. I'm using a system called StreamYard that's supposed to post to Facebook and to YouTube. So I think if you post on either one of those, that should allow, it looks like I do have a couple people saying hi. That's good. Hello. So hopefully my volume's all the way up on my thing here. So hopefully that worked. It worked last week. So, all right, let's see if we can do a couple. I was going to go about an hour. We're just pushing over an hour. So let's maybe do a couple more quick questions. Let's see. In a home loan, do bank officers come to the home and inspect the work? So maybe that's a new construction loan or something like that. So generally, no. You're not going to have the lender. That's where the appraisal kicks in. So the appraiser goes out, takes photos of each room, measures it, photos of the exterior, that type of thing. So that's usually the eyes of the lender are going to fall down to the appraiser, because that's going to be photos. They're going to certify. They're going to do certain things. So usually appraiser is going to handle most of that situation. Now, that doesn't mean if there's some sort of suspicion of fraud or something going on where they won't send out a representative. Generally, it's not the loan officer. I've never gotten a call and say, hey, go drive by this property before, unless it's like a fix and flip or distressed property already at that stage. But generally, I don't even see the home until I get the appraisal, and then I start looking at photos. So yeah, the appraiser is really kind of the eyes and ears, if you will, of the lender. And that's where even the title company can double check ownership and other liens and things like that. But the appraiser, it's a big report. It's probably 20 to 40 pages, depending on the report, that has photos, measurements, and notes and inspection and any issues with the home. The appraiser is supposed to note that as well. And depending on the type of appraisal, can be even more thorough. But it's not a home inspection. So if you do have any worries about the home itself, that's where the home inspection is going to make the most sense, because they're trying to find something wrong with it. The appraiser just kind of assessing the marketability, condition, those types of things. All right, looks like we got a live question as well. So let's go to the live question. How do you get some of these young families to qualify to buy a house nowadays? It is tough, especially when the median income doesn't afford the median home. We've always had that issue in Southern Utah because so many people here move with their income with them, either retiring or remote work or something like that. They're kind of bringing their income with them, so they're not relying on the jobs that are in Southern Utah. What I'm seeing more people having to do is co-signing. Brothers and sisters are co-signing, kind of get into their first home, get started, instead of renting, as long as there's enough space. I've seen that a lot more often. Or again, just help them with their budgets. Kids nowadays have more student loans, more debt earlier on than I've ever seen, because they get credit cards way too early, store cards. So helping them with their budget can help to get them into their first home, especially student loans. Some of the kids are coming out with $100,000 worth of student loans. It's just amazing. And we still have to hit them for a payment for that. But I'm seeing co-signings more often, having them commute a little bit more out of town. These types of things are what is limiting. But as far as like down payment, credit scores, we can really help with that. It's just maybe location has to be a little further out of town, or co-signing, or helping with the budget a little bit. Helping with the budget is usually frees up more money than coming up with $10,000 more down. But cohabitation, that type of stuff is becoming a lot more popular. So great question. That's a really good question, especially for our area. All right, let's see what else we've got here. Let's see if there's any other questions in the chat. I'm glad that worked. If you can tell me, where did you put that in the chat? I'm just curious to see if was that on YouTube, Facebook, or on the link itself. I'm just kind of curious on how this is a new system I'm using, so I'm just making sure I'm doing it right. So if you can, on the link. Okay, great. Okay, that's good. I'm curious to see if anybody posts on the Facebook or if it also pulls into the system. But this is only the second week I've tried the system, so we're going to keep messing with it. All right, let's see what else we got. Let's do maybe 3 or 4 more, depending on time. Let's see. What happens if I lose my job right after closing on a mortgage? Oh, that sucks. That just sucks. So if it's closed and done, then you have 30. If you start missing your payment, they will have to go into what's called foreclosure. So they have to give you a notice of when you're in default. They have 90 days to give you a chance to reinstate the loan or catch up, that type of thing, before they can actually go into foreclosure proceedings. And then if you're still not able to catch up payment or work out something with the lender, then that's when it goes to the courtyard steps. In Utah, they have to issue 3 notices each week that property is available to sell, and then it goes into the stage of foreclosure. So you do want to notify the lender, let them know what's happening, but it is something where the foreclosure department wants to get that 90 days out of the way. So they're going to keep that process moving forward, even if you're working with another department to try to maybe skip the payments or put them on the back end, that type of thing. But reach out to the lender, let them know what's going on. They may have other programs depending on the type of loan it is. But generally speaking, you got the loan. If you don't make the payment, that's the collateral. They're going to start the process of taking it back. So it's a sad situation. That's why a lot of loans, we want to see you have a little bit of reserve. We want to see that you can make the payment. If you have to take a month to get a new job, but they can start foreclosure. They did the loan with that asset. They can start the process of taking the property back, but it's 90 days of notice of default, then those 3 weeks. So it ends up being close to about 120 days before they can take the property back. One other thing is most lenders, if you're 2 months behind, they won't let you just catch up the 1 month payment. They usually want you to catch up both. So that's why talking with the lender early will help to make sure that any program you can have access to, they'll be able to help you with that process. The sad thing is a lot of times they want to see that you're already late before those programs kick in. So they almost encourage you to be late in this sense. So just try to make the payment if you can. Do whatever you can. Find another job. That life happens. That's just part of the risk of a mortgage. All right, let's see what else we got. I wanted to also, I think I can load this really kind of cool little, let's see here. Again, I'm playing with the system. Oh, yeah, I can do it. Cool. Technology. So here, I can add this to the stage. Let's see what this looks like. Hey, look at that. Cool. So here's myself. I work with Patriot Home Mortgage. You can go to ryanbolton.com. My assistant will help me with gathering paperwork and all that type of stuff. She's amazing. So that's kind of the team here at Patriot, on top of processing and underwriting, funding, appraisers, all that kind of stuff. But this is kind of the team on the front end that helps you get pre-approved to find out what loan programs you qualify for, that type of thing. So you can go to ryanbolton.com. I've got a great mortgage app on there. In fact, let me add that as well. Oh, this is cool. Technology, guys, is so cool. Oh, here, let's do this slide too. Take a look at this one. Now I'm just showing off. Okay. So there he is. Mortgage Nerd. This is just kind of my YouTube channel, my persona that I have on YouTube. I just thought it was fun, nerding out on the mortgage industry. The name was available. If nothing else, there's a lot of other mortgage nerds out there. So I thought it was just kind of fun to have the 3 instead of the E, kind of a backwards. So I have, my hat has a backwards 3 as the E. So it's just kind of a fun way to say mortgage nerd. It's kind of hard to optimize though, because like YouTube and Facebook don't know what I'm trying to say. I heard one of them was like Mortgage N3rd, because it was like Mortgage N. So it was Mortgage N3rd instead of Mortgage Nerd. But oh well, it was fun. So a lot of the things on the hashtags, I've made sure I spell it both ways, normal nerd and regular nerd. But then you can check out all the videos on there. I try to post reels. I try to post videos. I have Q&As. I have guests. I have all kinds of stuff on my YouTube channel. So check it out at youtube.com/@mortgage-nerd. And then also I've got a mobile app you can download. So let me put that in the feed here real quick as well. And this is available on the website at ryanbolton.com. So let me throw this in there. Boom. Oh yeah, look at that. So there's the QR code. So you can scan that with your phone. You can use it as a mortgage calculator. There's no fee for it. There's some great features that are built in there. You can start the pre-approval process, which costs nothing, to find out what you qualify for. It allows me to go to work for you on fixing either credit or what programs you qualify for, 100% financing, home equity lines of credit, whatever it is. A lot of it will start by going to ryanbolton.com or scanning the QR code and downloading the mobile app. So I hope you found this useful. I really enjoyed jumping on here and answering questions. I'm going to try to do this once a week or so, and love to earn your business. Again, ryanbolton.com. I lend in Utah and Nevada. Patriot, who I work for right here on Bluff Street, has lending in a bunch of different states. I think there's only a few that I've run across that they don't have a presence or a branch there or a way to be able to get it done. But I can answer your questions on whatever it is. Now, there might be some state-specific stuff that I have to research, but I don't mind doing that. That's why I like doing this. I love problem solving, helping you get into a home loan, and love an opportunity to work with you, whether you're a first-time home buyer, a real estate investor, upgrade, downgrade, whatever you're trying to do. I often use the joke that I sell money for a living for real estate. So if you need money for real estate, I'm your guy. Check out ryanbolton.com, and we will see you on the next stream. Thanks, everybody. Oh, I can change my outro. Oh, look at this. Hey, look at this. All right. Now I'll see everybody later.